Okay, good afternoon, everyone, and welcome to All You Need to Know About Transfer Pricing Controversy in Africa. I'm Cabrini McCarrick from Regan van Rooy. We also have Geoff Morris from Regan van Rooy here today. And of course, our very own Keith Engel from the South African Institute of Tax.
Honored to be
here. It's good to have you. So quickly, in terms of our agenda, obviously it's a big hot topic, controversy, transfer pricing controversy across Africa. So we've tried to break it into, a few different sections. We'll give you an introduction, talk about some of the global and African transfer pricing controversy trends, look at how TP fits into all of this, the audit process, litigating TP disputes, and we'll close up then. And we'll make it a bit discursive. Keith will come in with his challenging points, no doubt, throughout the session. But yeah, we're excited. Quick introduction. I'm Cabrini McCarrick, the lead transfer pricing partner here at Regan van Rooy. I was previously the African leader for controversy at Deloitte. We also have Geoff Morris, from Regan van Rooy, who is really our in-house controversy specialist, was previously with the Australian tax authorities and as a competent authority, and has done a lot of global work around APAs and maps, and really it's a pleasure to have Geoff with us to give us his deep insight. And of course, everyone will know Keith Engel, the CEO of the South African Institute of Tax. Keith knows much about everything, and it's a real pleasure to have you here with us. So I'll leave it to Geoff and then Keith if you want to say a quick hello or a bit about yourself in case my introduction wasn't sufficient.
That was fine, Cabrini. Yep, 20 years with the Australian Tax Office and Big Four, and 5 years as a competent authority. And I think my most complex MAP case or APA was a 4-country APA involving France, UK, US, and little old Australia. So pleasure to be here.
Thank you, Geoff.
And well, I think people know that I've been all over the place, but transfer pricing was more of a later thing for me. But I am no expert in transfer pricing, but I know enough to be extremely, extremely dangerous. But I enjoy being in this, and we've run this part of we've been running our transfer program for a while. But for my site members, at site, we deal with all aspects of tax, and we manage to get everybody together, and the goal is to share. And so I think we've been doing fairly well. So this kind of collaboration works well for us. This webinar is for the general public, whereas we typically run an in-house boot camp for the specialists. So this is a spin-off of that from our side. But again, I thank you for the opportunity, and let's see what happens.
Perfect. Thank you, Keith and Geoff. Okay, so the Africa Controversy Heap map. So what we've done here is we've put together this beautiful map of Africa with all these different colors. And what we've tried to do is highlight, real high risk jurisdictions. And by high risk, what we're seeing is you've got comprehensive compliance obligations in terms of your documentation and submission requirements, and also where we're seeing a high level of disputes. So in countries like South Africa, Tanzania, Kenya, Uganda, Zambia, Zim, they're quite advanced there, and we see a high level of transfer pricing dispute and only on the increase. There's a couple of green jurisdictions here. That's just so that people don't cry themselves to sleep at night. It doesn't mean there's no activity there, but it means we tend to see less. But I mean, the most important point is that across Africa, the vast majority have taken on transfer pricing legislation, and the tax authorities are really focusing in on this, which is why there's so many kind of disputes happening. So there's not many safe spaces when it comes to Africa. You need to get your ducks in a row. Okay, I mean, why are we seeing this increase in disputes? It's off the back of the OECD project and the base erosion profit shifting project, and with this major global focus on tax transparency. There's all of this information sharing through the country by country, the master file and the local file, which means tax authorities have a greater view, a bird's eye view of what's going on in multinational businesses. And it's become really best practice to be compliant and correct when it comes to transfer pricing, and it can attract real bad, reputational consequences if we're seen to be profit shifting from any jurisdiction, but particularly from developing economies such as we see in Africa. Documentation is the first line of defense. It's your narrative to the tax authority. And typically, along with that documentation, you're going to see various other types of information being requested if a tax authority is having a look at what you're up to. Businesses need to have a strategy in place because the onus is, of course, on the taxpayer to defend and support and evidence the arm's length nature of his business. And your documentation is one step in the process of kind of controversy management. From a tax authority perspective, we know the revenue authorities are under pressure. There's much discussion in various African jurisdictions, budget and politically, around this. And of course, any clever, prudent tax authority is going to follow the money. And certainly they see money when it comes to transfer pricing. Off the back of that, there has, of course, been a lot of skills building with the African Tax Administration Forum, with various other tax authorities helping African tax authorities, such as the Scandinavian tax authorities, interaction with the OECD and the UK tax authorities. So lots of happening there. They're not just saying, yeah, we're going to tackle you on transfer pricing, but they're also trying to build their in-house capacity and skills. And I know, Keith, we see people from SARS doing the site transfer pricing course as part of the strategy to upskill their people. There are a number of dispute resolution mechanisms available to the taxpayer, so it's not just your documentation and responding to queries. There's also advanced pricing agreements and mutual agreement procedures. Of course, in South Africa, we just have this draft legislation recently issued around APAs, so we're quite excited to see where this goes to. It's a big step for the South African tax authorities. And of course, it's all about securing tax certainty and trying to better manage, all these debates that you can have about perhaps the subjective topic of transfer pricing. In terms of an audit, it's not just time and money, and we're talking very high value exposures are typically seen in transfer pricing. It's also about your reputation and this concept of being, a good taxpayer and how that can impact the wider stakeholders in the business.
The point here, I think you're covering it rather well, is that I think politically it's become the issue. So,
yeah.
And part of it's been linked up as sort of an anti-colonialism issue. The feeling is that some of these multinationals are taking advantage of them. It's a new form of colonialism. And you cannot, the ATAF has stoked a lot of the flames, not just OECD. So ATAF, when they do training, they do a lot of training of their revenue authorities on transfer pricing. That's where they're most active. Politically, they keep pushing it. You'll hear our commissioner, and we're going to make a lot of money from transfer pricing. So they look at it as a pot of gold.
Yeah.
And you're presumed under suspicion. So they've really taken an active thing. And from what you've seen as well, is that a number of them have actually beefed up their local capacity. And yes, when you have the Swedes and the Danes come to town, they run their own audit. So you'll see a lot of that as well. So it's really become the political flavor of the day. And it becomes, if you make big mistakes, well, if you ignore it, you ignore it at your peril. Let me just leave it at that.
And it's a little bit, you're guilty until you prove yourself innocent. Exactly. Because the burden is on the taxpayer through the documentation, the tax authority has a very wide-ranging ability to request all types of information. So you're kind of at the back foot, really. But yeah, so there's definitely a lot of focus there, and it's not just the tax authorities, it's these wider bodies that are putting this pressure on. Okay, so just a couple of the kind of the key focus areas that we see in terms of controversy. So there is industry focus. So sometimes the tax authorities will focus on particular industries, and we've seen that trend. And they're often focusing on, what are the important industries in particular African country that you're looking at? Because again, remember, they're following the money. So they're not going to be looking at the small fry in the first instance. They're going to be targeting in terms with industries that are high value and also where they believe that there's a potential for inappropriate transfer pricing to occur. So we see it in the mining, the energy, generally exports, so across the agribusiness, telecoms, manufacturing, consumer business, and technology. And basically, you will also see it if you're part of a large multinational. Again, there's money in a large multinational. Maybe you're multi-jurisdictional. Maybe you've got, headquarters outside of Africa. There's going to be a potential appetite to further analyze your transfer pricing. We also see a big focus, this is globally and in Africa, around IP and intangibles. No longer can we just say IP is legally owned someplace. We have this focus on DEMFI, development, enhancement, maintenance, protection, and exploitation. High value transactions, and where you have an IP risk, you tend to have a historic IP risk. So it's not just in 1 year you paid too much for your services. It's the concept of the period that's open for the audit. Has intangibles and IP be treated correctly within your group? Have you identified what they are? And, are the right people paying for the right things? We also see a lot of focus on financial transactions. They probably were typically a bit underlooked in terms of transfer pricing previously. But with the new OECD paper on financial transactions, what SARS, the papers that SARS have released to give clarity around it, and of course loans tending to be high in value, there's a lot of focus on that as well. And it's not just the interest rate, which is what people can sometimes forget, it's the quantum of the loan. Would an independent party actually lend you this under those terms and conditions? And at the end of the day, it's, is your interest deductible? Or are you charging the right amount of interest? Big focus in Africa when we're dealing with low tax jurisdictions. And, Zimbabwe has even said in their legislation, even if they're not related party, we're going to look at any transaction that you have with a low tax jurisdiction. So they're saying, we don't really believe your structures. If it's with the low tax jurisdiction, we're going to make you prove it's arm's length anyway. So we see issues with that, of course, when you have a Mauritian structure, which is very common in Africa. And what's important there is that it's not just a legal setup, but that you've got substance and significant people underlining this. You'll also see a big focus on loss-making entities. If you're part of a group and you're continuing to make losses, would a third party do that? Or would they close up shop? If there's a significant shift in profitability, you're likely to be to potentially be looked at. And of course, with COVID, we're seeing that actually now you've got to explain and sometimes strip out the COVID impacts on the business. So you can explain what happened is, based on commercial outside of your control factors and not on transfer pricing. Big focus globally again, and there's a lot of case law around it on procurement hubs. We have a tendency to leave a large margin sitting in our procurement hubs. That's being tackled very commonly. And of course, high value transactions. So if 90% or 100% of the business that you do, you're buying goods from a related party or you're selling to goods, you're much more likely to be challenged. Because most of what you do can be tackled. So they're high value in there. Services, of course, are very commonly challenged in Africa, and there's more of a focus on, is it the correct cost base? Is it the right allocation key? Are you paying for stuff you actually get? Are you getting benefit for it? Duplication of services, as opposed to whether you charge a 5 or 6 or 7%. Although, of course, the tax authority will look at that too if it suits them. With business restructuring, and sometimes it's forgotten, any type of business restructure, a merger, an acquisition, a change in the functional profile, triggers a TP review, or should trigger a TP review, because you have to look at that, and sometimes it goes unnoticed. And And of course, the big one, all of this, if you don't have documentation, appropriate levels of documentation for your transactions or explaining your business correctly, you're essentially sitting a sitting duck in terms of defense. So not only you got a compliance problem, but you've got an exposure problem, and you're really sitting kind of where you don't want to be sitting. Keith, any comments on that? This is going to be my last slide before I hand over to Geoff.
Yeah, just 2 points. I mean, I agree with everything there. The question I know is about royalties. Do they challenge a lot of those? My understanding is they challenge some, but it's more, the problem for them is they can't get good comparables. So if you're going to get a challenge on royalties that look excessive, it's going to be more of an emotional challenge than anything else. And then the second one is emotional. I mean, is Mauritius becoming increasingly viewed as the #1 enemy? You know, that they'll scrutinize that more than anything else, even Netherlands or Ireland or all of those? Or do you find that anybody that's outside the continent is scrutinized equally?
Yeah. So on the first point, royalties, we see that they're quite typically challenged. So first of all, is it inappropriate to even charge that or pay for it? What are we getting for that? Sometimes group will just charge a royalty and they don't think about the individual jurisdictions and whether or not it's valid. In terms of where the royalty sits, we were able to find pretty good comparables when it comes to this. They are publicly available, and the tax authorities are getting much better. So I would say it's the first question is there true intangible there that you're paying for? Yeah. Or is there one there that other entities should be paying you for? Let's say you're a South African multinational and you've got, the big brand and everyone's operating under your brand and you share operational systems or know-how, whatever. Oftentimes it's a question of we haven't identified it correctly. And of course, with the master file now, you have to talk about your intangible strategy. So we're more at the stages that intangibles is probably something that hasn't been fully or correctly analyzed to the extent that it should be, rather than whether it should be a 2 or 3 or 4% of revenue. That's the secondary kind of issue. In terms of Mauritius, Mauritius has taken a lot of steps to be a strong and reputable but attractive jurisdictions for businesses to operate. And there's a lot of other benefits to Mauritius than, of course, the nice tax rate. But 100% you're going to see similar challenges in Seychelles, the Isle of Man, Ireland, Dubai, Singapore, many jurisdictions. Yeah. But beyond that, the tax authorities don't stop there. That's just one that they're likely to look at, but it can be any jurisdiction. Yeah. So we see challenges from, with respect to transactions into loads of countries, into Europe, the US, even multi-jurisdictional in Africa. It's because the tax authority is only looking at their local base. And if they feel that their base is being eroded, they don't care which jurisdiction. They're still going to tackle it if they feel there's money in it. I'll quickly just finish here with the controversy life cycle. So we've just summarized a few points. So typically how it works is there's a request for information, and sometimes these are standard and simple. It could be your documentation, this, that, the other. And they might proceed then with an audit. There tends to be a lot of information requests going back and forth where they'll ask you for all sorts of torturous information that often people don't even have. They don't even retain that information, or it's by another entity and they can't get their hands on it, or it's going back so many years that, the person who used to be the tax manager or the commercial director is no longer there, and maybe they're off sunning themselves on the beach in Mauritius, who knows. But you got these kind of problems in terms of the information, and it tends to be back and forth. Then there can be a letter of findings where the tax authority will lay out all of its angst against the taxpayer and what its position is. And then there's a response to the letter of findings where the taxpayer has a chance to discharge the burden of proof through the various types of defense to whatever the issue that SARS might be raising. And then it often comes to a negotiation or settlement, which we see has been the African trend, that it gets negotiated and settled pre-court. But what we're seeing more and more of is that taxpayers, certain taxpayers want to set a precedent and are saying, we're not just going to settle unless there's true TP technical merit to this, unless we're actually doing something wrong. Because if we want to continue doing business successfully into Africa, you know, we want to be correct. So there's a tendency that we will likely see a few more of the court route, which will set a strong precedent for African taxpayers and tax authorities alike. And then at some point you hope to wrap up and finalize your audit and hope that the tax authorities aren't then going to start assessing the next years that remain open. So it is a tedious and complicated process that we go through. But what I'm going to do,
process, just so you know, I mean, I'm assuming it's going to take at least a year or two to resolve once they get going, even if it's successful, right?
Yeah, 100%. I mean, we typically can see 2, 3 to 4 years. There's often the tax authority will request an extension, you know, in terms of that period. Taxpayers kind of always have this challenge. I want to seem like I'm doing the right thing to the tax authority, whatever. So they often agree to those extensions, but it can be anything from 1 to 4 years. And there's some people who say it'll never end. So the business does have to make commercial decisions along the way, but when it is relating to the underlying business model of how they do business and when, you know, the commercial rationale, it's not just simple to say I'm just going to keep settling with the tax authorities. We have to pick the right fights at the right time, because it creates important principles for how we do business in Africa.
Yeah. And then just the other one is, do you see a lot of rushed audits? I mean, Tanzania for a while was really gone crazy where they just threw these things out. Do you see much of that anymore, or are they much more professional now?
What I would say is, since the Tanzania government shift and the shift in direction there's been a substantial improvement in terms of it was very difficult to deal with the dispute with the Tanzanian tax authorities, and it really seemed like, you know, if you were talking transfer pricing, you were talking to a wall. I'm just thinking who's listening to this, but it's significantly improved since the government change. It's much more reasonable, and, you know, because the tax authorities have to apply reasonable standards, because you've got to balance these exposures to interacting investment and doing business, and you have to find this. So I would say there is an improvement there. And generally we will see rushed assessments towards the end of a tax authority's time period. You know, everyone will want to make sure that they're hitting their targets, so there can be an association with that, just like kind of trying to close things up towards deadlines. But usually they're not rushed affairs. Usually they're take a bit more time. There is considerable amount of thought and energies put into these matters by tax authorities. Sometimes it seems like they might be stabbing in the dark, but I would say it's a very conscientious approach to transfer pricing by the African tax authorities now. Certainly a vast improvement in terms of they're also putting their money where their mouth is in terms of trying to get their resources up to speed and being able to deal with these complex issues. Okay, let me jump over to you, Geoff, framing the transfer pricing issue.
Thank you, and great to be here. From the conversation, Cabrini and Keith, it's so much of the transfer pricing is both the same and different. What you're experiencing is what I've been, you know, through 20 years of exactly the same, and, you know, it feels like Groundhog Day almost every day, but the cycle repeats itself. But when I think about litigation, you know, and controversy and dealing with audits, you know, often there's a continuum, you know, about when do I start to engage properly with the fiscal, with the tax authority? Do I do it through my documentation, have really good documentation? Do I do it through how I respond to the audit, or do I do it when I deal with the letter of audit findings, or do I do it just before we get to the courthouse steps? So there's quite a different approaches there. And in talking about, you know, controversy, you know, it's hard to be definitive about, you know, what to do in a TP dispute, because there's really scope for differences in the law and the facts and the transactions and the evidence you have and the guidance and the availability of experts. And so there's no real playbook for this kind of stuff. But when I talk about framing the audit as really about trying to, leverage what we know about the law, what the rules of evidence are, how we get our experts, how we can use our TP technical analysis to actually work, hopefully with the fiscal, so we can actually come to a common understanding about what arm's length is, and in that way reduce the cost, improve our reputation with the fiscal, and actually give us some basis for moving ahead in future past the realms of the narrow audit. But I think what I can share during this, because it is so difficult, there can often be a clear litigation cycle, but from 20 years of controversy and transfer pricing, being on the fiscal side and writing the economists' position papers to, present the taxpayer with $100 million worth of adjustment or $500 million worth of adjustments or $1 billion worth of adjustments, it really puts, your mind into a certain frame about how you can present that face-to-face with the taxpayer. And so what I want to bring to you today is some general observations about negotiating those TP disputes. The first part of where I come from is trying to work out what the transfer pricing test actually is. What does the law say about, what the transfer pricing standard is in your jurisdiction? And an audit, just think about what an audit is. It should be about applying the law to test whether a deduction or a revenue item is correctly recorded. And obviously we know every country has different legal standards. The legislative basis is different. And some of them are very focused on determining what the consideration is, what's the price. Some other jurisdictions are very concerned about getting the structure to be an arm's length one, and then extrapolate from that arm's length structure an arm's length price. And we can see some of this in the South Africa's own test, and this is the amended section, and it talks about measuring a tax benefit as the source of the problem. So that's a calculation. They have to demonstrate that calculation. They have to identify a transaction, operation, scheme, and so on. But then they have to identify what the terms and conditions are that would have been different under a arm's length situation. So if, in my mind, if a South African audit simply applies a TNMM profit method and says to the taxpayer, you're out by $50 million or $100 million, then the tax authority has to demonstrate that it's a different term or condition in the arm's length arrangement. So it's a very, kind of in my mind, a clear legal test. And if they're not doing those two things, then I would be asking the question, what makes you think that a difference in profit actually, relates to a difference in term and condition of an arm's length arrangement? There's a whole lot of other commercial factors that can can affect the profit outcomes. And so the legal test has to be quite tightly defined. The next part of it is trying to work out what the status is of the OECD transfer pricing guidance or the United Nations transfer pricing guidance. Is that mentioned in the income tax law? Has the guidance been specified in as regulations? For example, in the US, the IRS regulations are very extensive about transfer pricing, but in other jurisdictions, there's none of that. There's just none of that. It is really just, the law is really silent on how to go about measuring an arm's length price. And again, which means that if someone is following the OECD guidelines, you have to ask the question, is that enough? If the fiscal has just followed the OECD guidelines, is that all they have to do? Well, often the law doesn't say they have to do anything. They have to make a case. They have to make a case to the legal standard. And sometimes there's quite a bit of confusion about the status of the OECD guidelines in different jurisdictions. And again, we can point to the South African Revenue Service. Looking at the 99 version of the Practice Note 7, it talks about The OECD guidelines should be followed in the absence of the terms of the practice note, the provisions of the 31, which is the arm's length standard, and the tax treaties, which kind of confuses things a little about just what the status of those guidelines are, and that the guidelines can't be read into the law just by virtue of this practice note. We have to be very clear about that. So just because the fiscal has said we followed the guidelines, that may not be enough if the following the guidelines doesn't give a compelling read on what the arms price should be.
And Geoff, on that, I think that's what we see in practice, quite a selective approach. So sometimes the tax authorities will quote the OECD in their, in what they're saying in terms of their challenge, and sometimes they will ignore certain arguments because they're OECD. So there isn't a fully consistent approach to that, and it can appear a little bit selective at times. And I think that's part of, as kind of advisors in this space and working with the various tax authority, trying to kind of improve the process around that. So tell us what you really want. Tell us how we can accomplish it, because that's what most taxpayers want. They do not want to be stuck in this controversy. They want nice, clear rules that they can apply and, hopefully set it up in a commercially good way that works for everyone. So we need the tax authorities to be, kind of more in there and actually come up with their interpretation of things and give clarity. That said, we are getting more and more guidance from various tax jurisdictions in Africa, but it is still a little bit, can be seen as selective, I would say.
And one of the big faults I see in tax authorities applying the guidelines is that they read it just as, I'll do a very simple functional analysis. I'll then go to find comparables and I'll apply a profit method and job done. But what they often miss out on is understanding the commercial context of the company. What was the company trying to do? How were they trying to operate? What are the non-transfer pricing reasons for what they did? And so and the guidelines only broadly talk about understanding that context, but the uninformed analyst can just go, I'm just gonna, this is a distributor, so I'll get some comparables and profit methods will be fine, and that's my job done. But that's not usually what should happen.
It's such a critical part of the analysis, because understanding the business, you can't have any transfer pricing until you understand the business and the economics of the business and the commercial of the business. And sometimes that's what we forget. That's why kind of transfer pricing is so collaborative between the advisor and the taxpayer, because you have to have the business intimately captured in terms of its model so that you can then frame the transfer pricing model or policies around that. And I totally agree with you. That can be ignored or overlooked, and it's a fundamental part of transfer pricing in general.
Yeah,
exactly.
When we teach it, and that's one of the challenges why it's so hard with the boot camps and all of that, we've been using practitioners, is when you teach it theoretically, the OECD guidelines are not a series of bright rules. Yes, there's some basic things you can follow, but it's very much, I would call them rules of thumb. But really what is underneath, it's just not like reading a regulation or, maybe the US tried to do it, but nobody else tried to do it. It's more rules of thumb, and the underlying thing is to understand the commercial basis. And the challenge that you see in Africa, and I think you know that rather well, is that they simply look at amounts or quantum. So they sit there and go, oh, this is a large amount, or this looks like to challenge it. They think a deduction is more of an incentive. And so a lot of times they're challenging standard routine commercial practices, which in theory you should not do, but it's very hard. The rules don't give you enough comfort on that. And so if somebody doesn't understand the commercial business and why this is normal for that, then you have a major problem, and then the papers will go back and forth. And as I said, Tanzania was the worst case ways back when. So it's very hard. Look, I'm a lawyer, so when you look at it, you're looking for bright line words and rules. You just don't get that here. You really have to start with a good commercial understanding of things, and then you get to your result. And the rules are really just rules of thumbs around that. So, but I don't know if it's very hard if you're very legalistic to go that way for a revenue authority, and it makes it challenging in some of these African things. So that's just been what I've seen. Anyway.
Yeah,
why
I
it
agree.
makes,
Yeah.
Sorry, Jeff. It's why it makes transfer pricing like such a strange one. It's not normal tax. It's not normal law. It's a whole different kettle of fish that rides over it. So it generally attracts weirdos and strange people to transfer pricing. Isn't that right, Jeff?
That's right. Well, to Keith's point, what I've done in the past, and I've had to do this, is I've done a word search for the OECD guidelines for the word must, as in a regulation, as kind of make it a regulation, almost authority from the OECD. Hardly ever appears. The OECD guidelines hardly ever say must. All they say is may or should or could.
Yeah.
Or would, which really means that the OECD guidelines are a framework or a, and they would say this themselves, they're a methodology. Here's the steps you go through, and there's a whole lot of factors which the fiscal should take into account, a lot of factors that the taxpayer, when their documentation needs to take into account. But more importantly, here's a whole list of things that you can present to the court about the things that you've taken into, we as a taxpayer have taken into account, and all the things that the fiscal has not done. In trying to narrow down the reasons for the difference in profit, say, to a transfer pricing one. So it's a different, when you get to a controversy space, it's a different reading of the guidelines, and it really, but also makes it a little bit more difficult, because if you do something, you can't refer to the guidelines per se in a controversy sense. You need to refer to third-party actions, third-party pricing arrangements, agreements and so on, which is why, if you have a royalty arrangement, a comparable royalty is really good, not just the rate, but the terms of the arrangement. So getting an agreement, comparable third-party agreement, is really, really important. And we'll see this time and time again in litigation. The courts that I've seen, unless they have nothing else, their preference is for third-party arrangements, third-party pricing, the people in the business telling me why they did X, Y, and Z, what's the commercial explanation. But, so often the fiscals don't get to that point. And it's a lot of work for everybody to get there, but that really is the standard which the courts are trying, that I've seen that courts are trying to apply, unless there's nothing else, literally nothing else. They'll make a decision based on whatever they have in front of them, really. That's why we say, go on, Keith.
To close, in that sense, it's guidelines. They're not absolute rules. That's what you're saying. It says guidelines for a reason, and these are to take into account, as you say, not absolute rules in the right circumstance. And then I guess the main point is that when you're doing your TP documentation, it's important to draw up the narrative as to the why, rather than just putting some absolute numbers, so that you've got a story, and a good, clean story will go a long way, if of course that story makes sense. So anyway, I'm sorry to interrupt, but that's a good way of saying it. I think you're on the money there.
Yeah, and just to round out this slide, we also see fiscals trying to kind of hypothesize what a third party would have done, which is my point around, they use that to try and overcome wallpaper over the gaps and the problems, the things they haven't done. So let's move on to the next.
Interesting.
So we've done this one. Here we go. Court's approach. So if you're a court, often focus on the letter of the law. Well, I prefer to do that. So every court will have its own rules of evidence, and can apply quite a high standard for a transfer pricing analysis to me. They won't accept suppositions or assumptions without evidence, but they are assisted by experts in the pricing and the commercial arrangements. That can be informed by company witnesses. So if a managing manager of the business, can provide a witness statement to the court about why they did certain things or how they come to that decision, then that can be quite compelling, because they were standing in the shoes of the business at the time and can explain the commercial context for the pricing. Some courts are also reluctant to alter the terms of contracts, even if they're related party contracts. The court may stick with what the fiscal might see as a bad arrangement, and it might shift risk or responsibilities to one side or the other. And sometimes the court may stick with that contract because there's no evidence to support one way or the other that arrangement is third party or not. And the first part of thinking about going through this whole controversy piece is obviously it all starts at the audit. The audit stage is a time when the kind of the bones of the controversy are taking shape. So if you want to influence whether there's an audit or not, you want to put the right information in front of the tax authority to make sure they understand what you've done and why you've done it and why it makes sense, why it meets. If they want to have an argument about the OECD guidelines, why it meets the guidelines. If they want to have an argument about the law, why it meets the requirements of the law. And obviously lots of people would understand there's going to be a lot of questions. A lot of those questions may go to a lot of issues. They might have a wide scope, lack of a lot of clarity. Don't really know what the information is that the taxpayer has. But really what the fiscal is trying to do is test, all the different compliance hypotheses that they might have to try and choose the best one or choose which are the alternatives that they might make the basis of an audit finding. So when you're dealing with an audit, it kind of goes without saying, but understand the implications of the information that you have and that you don't have. Know what you know and what you don't know. But also obviously manage deadlines. Sometimes it's going to be they're really going to be horrible. You've got to work out what your extensions are going to be. Obviously, horrible is a technical term for really tight time frames. But you might also have to start thinking about if your staff are being interviewed, which would be a very normal practice where I come from. Whether those interviews are going to be informal. Whether they're going to be recorded or whether they're going to be under oath, which means that they're admissible in court. So each one of those things is needs a different strategy. And obviously,
just the interview process is indeed very common, particularly by the South African tax authorities, and there is normally it's quite typical that the people that they're interviewing haven't really heard or know much about transfer pricing, or may have the understanding, the full understanding of the interactions. And the tax authorities, it's quite a complicated affair because all this information serves a purpose of some sort for the tax authorities. Sometimes, and you were a tax authority, so you can tell us, sometimes it seems scattergun approach. But I've kind of learned over the years that there generally is a very clear purpose behind the activities. It's very wide ranging, but they're looking at all angles, and the making sure that the narrative is presented in the true reality of the business is very important, because one individual may not actually fully understand the role. I mean, one of the things that we see very commonly is what we think our own job is really important, and we don't get any benefit from group or whatever because we're doing it all locally. And it's often not the case, because you might be using a super high value brand locally, or there's a load of stuff that you don't know that's getting. But of course, if the business isn't aware of the bigger concept, there can be many things that are not helpful said in these type of interviews. So I totally agree with you. We can't just willy-nilly submit responses to information without considering, is this explaining the story? Like, if it's not, should I be looking at some additional information that I should be submitting? Is it at this stage or is it later in the audit to present the narrative? So I think the information can seem like real tedious, but it's actually absolutely critical to the later stages of this dispute.
You need to get the bones of the audit of the controversy right, and you've got to shape them almost in a way that you can then deal with if there's an audit finding later on. And, responding, obviously, to information requests, really important. Obviously, everyone's going to say, respond truthfully to those requests. You've got to make a decent effort to get the information and find the information, because there might be additional penalties later on, but only by having a truthful response are you going to get your side of the story. But when you're responding to these information requests, think about, as Cabrini and Keith are saying, you might have to go the extra mile and explain the business and commercial context of what's going on. Even if we have to provide this contract and this set of invoices and this explanation, and we have to, do these interviews for the functions, assets, risks, and so on. But if there's something missing that's really important to provide about the business and commercial context, think about getting that up into the audit context right up front, because that might put a line under the whole issue going forward. And of course, there's a parallel process here. If timelines to responding to an audit are short, you've got to start thinking about how you're going to respond to an audit position, well before you get the audit position paper or the letter of bindings. Think about engaging the TP analyst, the advisor, the expert, the commercial advisor, the commercial expert. Consider getting a preliminary legal view about how your arrangement might be tested. What evidence do you need to determine the veracity of the arrangement? Think about whether the fiscal intends just to apply the guidelines or whether they're going to make a real strong legal argument out of it. And they're two different things when you come to try to resolve the controversy. And is there a prospect of resolving the audit before litigation? Is there a possibility of negotiation and settlement? But having a strategy is important. Don't leave it to chance. And when you get the letter of findings, think about, how, Keith.
Just a question there. To some extent, how often is the problem that the taxpayer has rushed their initial documentation, their local file, their master file? They've rushed that. They've done it as a paper exercise. And now when you go back, you're having to dig. And part of from what I can see is a lot of times, if you're doing the tax afterward, the agreements may not be right. It might, the tax part might have been done based on the truth, but oftentimes agreements aren't reflecting a reality. So a lot of times when you're doing an intergroup agreement, it's written for expansiveness, but it doesn't represent necessarily what's actually happening. And so to some extent, I guess, when you're doing your annual review, you really need to make sure that documentation is improved rather than having to wait for litigation and then it's too late to change things. I'm not sure how often the facts that way undermine you. You kind of also said about witnesses. Sometimes witnesses don't really know what they're saying. And SARS is trying to catch on to a word, or the Revenue Authority, ATO, and they don't realize the implication of that. And actually, they're actually wrong. So the facts seem to be, it's a very fact-intensive exercise, and getting control of the facts earlier. How much can you do that before the audit? Because by the time the audit is going, now you're kind of stuck. You can't really do much at that point.
Yeah. Keith, I think it's an excellent point, and I think it's actually critical. So it is very much after the point that a lot of groups are then trying to explain their narrative. And often it's the case is that it is a paper exercise to do your first set of documentation, right? It's all new. There's so much to do. You start off with something. People aren't that willing to invest in the process. A tax advisor can't do it in isolation. It requires the business. And if the business doesn't prioritize that, you're kind of getting your bare bones documentation approach. And it can be totally fine if you never have an audit or defend. But because it's not just the document, your document and your financials and your legal agreement and your tax returns and what's happening on the ground all need to tie up and tell the same story. Otherwise, you're going to have the same TP exposure and assessed and checked and the same problems unless you're looking at this type of reconciliation of data and fact pattern. And I totally agree with you. I think it's very key in terms of, on the whole process, and even the functional analysis interviews that's normally done for transfer pricing. That in itself, you'd normally be interviewing the same type of people there as the tax authority would later. So it's actually useful exercise for the business to be a participant in the documentation process, because they understand risks and things that they need to consider, and it'll help them down the road in the event of various disputes.
It's a really good point. And when I was with Big Four, sometimes you do a documentation study for a client, and you would say, well, we're going to come out and do the functional analysis interviews, and it will be the same process as the fiscal would do. And you're always, though, trying to get to the underlying, understanding of the business and the commercial considerations that they had. And one example I had was I sent the documentation out to the client, and he rang back and said, "Where's the covering letter?" It's like, well, I want to get the documentation right. What do you think of it? He said, "Oh, I'm not going to read it. Just all he wanted was the covering letter, right? Just to make sure that his business need was met, right?" And so on. So there's a big difference here. But I think, documentation does evolve over time, and it has to, because the fiscal and the environment you're working in evolves over time. Just think of what you would do before the chapter on pricing debt instruments, say, or before the OECD chapter on restructuring. What would you do then would be far different from what you would be doing now. Or if you're looking at the South African legal test, before you might do one thing, but after you have to do something else. And they're quite different things. But obviously you have to be strategic. You can't do everything to the nth degree. You've got to pick and choose, and you've got to continue to refine and update. And one approach I encourage clients to take is the TP documentation, to a degree, it's going to be necessarily summarized and get to the key points, but it's got to then form the architecture of your transfer pricing defense. You've got to almost make sure you memorialize in that TP documentation why you've done it. You may not put everything in there. You might have a memo off the side from the managing director saying, we've adopted this policy because of that might go, useful background for the tax department, but may not go into the TP documentation in that format. Might go into might pick out some of the issues and so on. That's a very, very, very good point. But I think let's get through this, letter of findings. You're responding to the position paper and letter of findings ahead of time, can make sure you give yourself the opportunity to have a really compelling response. And of course, as soon as you have an inkling about, an audit coming or a letter of findings, you've got to start thinking about the double tax, penalties, interests, all those other adjustments, and think about some of your options as well. MAP, APA, litigation, so on the courthouse steps. But one thing, let's go to the next slide. This engagement with the fixer. It's actually something that is a kind of very natural experience. For me, often get, as a common authority, get phone calls from the taxpayer, and they spend the first half hour on the call arguing or telling me the story about how bad the audit was done. And it colours one's mind about the reliability of the audit findings. But I think it's an important one because it does go to are you getting a fair hearing with the audit team? Are these people who are letting you say what you need to say? Are they incentivized to apply the law, or are they just going to apply the OECD guidelines? What kind of arguments are we going to have about that? But also, when you get to negotiate the letter of findings, there's a couple of things we have to do. One is, think about the TP technical parts of it. Then we are picking up the OECD guidelines. What does the guidelines tell us should have been done? Have they done it reliably and appropriately? When you're trying to negotiate this, can you say, well, we should have included that comparable. That changes the bottom of the range by, minor amounts. Yeah, but we're still in the range. might show that you're open to, some joint resolution of the issue. But all of it's going to be very case specific. When you get expert analysis, are the commercial industry experts available? Are there witnesses, or lay witnesses from the company available? If you say you're having them, being sought, will that put the fiscal under pressure to walk away from a poorly formed transfer pricing adjustment? And also for a mechanical thing, have a good, reliable spreadsheet. At some point in the resolution, you might have to share this spreadsheet so everyone comes to a common idea of what the number is. And when you put a counter offer, think about putting it as a package. So rather than say, oh, we can agree with that comparable, you may say that, but you might mean we can agree with that comparable, but we're going to take the upper part of the range or the lower part of the range, and we're going to have this working capital adjustment, and we want this trade-off on the interest and penalties, and that would resolve all of the case for X amount of dollars. That is what a settlement looks like at the final stages. So be aware that you need to go through the conversations and all of the arguments, right from the TP technical, right all the way through the legal arguments and the arguments of penalties and interest to get to a dollar figure at the end. And remember, MAP may be easier. MAP may be available in your jurisdiction, but it may take longer. And it's easier because someone else does the work.
Just a question here that I was thinking about is, look, the problem it sounds like is how much money you put in. There are two things you have to put up front. One, you got to put some money in and some time to pay your advisors, and sometimes people don't want to do that. But second, it's not enough to just give them money, as what I keep hearing is you've got to give them time. Don't just read the cover letter. You've actually got to go through and say, actively read this and say, does this make sense of what you're doing? Does this fully flesh out? And it's important also to give time to do the interview process. I mean, I saw that a lot of times in a law firm where, one side doesn't tell the other what's going on. They'll just dump a large agreement on somebody and say, figure out the tax consequences. That's a huge waste of time. You really need to be able to interact, to get to it quickly. It saves time. But the other one that seems to pop up too is local files. Now, here you are in Africa, you've got a big multinational. Let's say they come out of Australia to make it easy for you. The Australian company is doing its master file. The master file is built around the Australian company. And then the local file is sort of like, well, that's what they've said in master. There's not a lot of room to maneuver. Therefore, we just kind of have to accept in the local what's in the master. And, how do you deal with just kind of going along? And they say, well, the company in Australia is bigger. They are the parent. So we just have to do what they say. I mean, is that a problem? Or from what I've heard, it is a bit of a problem, but maybe I'm exaggerating.
Well, I think it's a bit of a problem because in a way it says the local taxpayer doesn't have control over their transfer pricing. That an arm's length party, there'll be two sides to the transaction.
Yeah.
What commercial context would mean there's some level of bargaining and negotiation. I'm sure you don't always see that, or in some cases rarely see that, within a large multinational, it's really a price handed down. But if the price if you're just accepting the transfer price that is given you, then the fiscal may be able to make the argument that the arrangement itself is not arm's length.
Yeah.
It is just a price given to you and that's it. There's no, and if you were to say that to the court, then the court would be saying, oh, I see what's happening here.
Yeah.
What's the arguments from the fiscal about what the arm's length standard says, and the company says, oh, hold on, but there's real problems with the taxpayer's analysis. The court might say, well, what have you got to say? What I heard the other guy say was that you're just dictating what the price is. So there's no bargaining.
Yeah.
There's no negotiation. How do I know anything is arm's length from in that kind of arrangement?
Yeah.
So there needs to be, you need to demonstrate not I'm not saying you have to go and negotiate every price, with your parent.
Yeah.
But you have to demonstrate that the price is arm's length for you. That's
Yeah.
what your local file has to say. And if in the process of forming your documentation, you're saying, hey, I think there's an issue here, then you've got to get on to head office and say, your group policy doesn't seem to work for us. Can we talk about it? And, the head office might be thinking, well, some of the issues we can see, and, we'll tweak the pricing to get this outcome or that outcome, or no, your group policy works because of these things that you haven't taken into account and so on. So it is a bit of a conversation.
At the end of the day, if it's a problem for the local subsidiary, it's a problem for group, because they're the counterparty to the transactions. If you're going to get challenged, it's not just a local problem, right? It's a group. It's how it is. If you've got a problem here, you could have a problem in many corresponding jurisdictions where the policy is similar. And at the end of the day, you're going to have a problem getting those payments out to the parent. So everyone cares in terms of the group. It's whether they're if there's a local problem. And I think we see more and more that the stakeholders of the business are more involved in the TP process to make sure that there is an understanding. Even if we run autonomous businesses as part of a group, transfer pricing needs to be looked at more holistically than standard tax, where it's the local entity's problem, because it simply isn't local. It's local plus.
Yeah, and the economic damage that transfer mispricing can do is, sure, you might get economic relief through MAP of the pricing issue, but you won't get relief for the interest and penalties. That's a real economic cost to the business. And that's
sorry to interrupt, but those penalties and adjustments can be between 100 to 200% of the value, so they can be more than your exposure potentially. Like there's this huge value in that, so it's quite critical.
Yeah, and in a way, if you had a algorithm going on in your head about, when you were doing your documentation, how much money do I spend on documentation? What's my exposure? Well, it might be weighing up what's my penalties and interest, of getting it wrong. How wrong can it be? What's my penalties and interest? So you might be trying to weigh up, your documentation expense around what's your penalties and interest. Obviously, you may not ever be audited, so that could be an issue.
But it is cost versus benefit in terms of some groups have very low value transfer pricing, have pretty standard transactions, and of course people like that don't need to go and write out a whole go crazy when it comes to their documentation. But if a large portion of your business, or you have high value transactions, or even many different transactions that add up to high value transactions, then your exposure is not just that the TP is wrong, as you say, it's the penalties or other issues, but you have to still prove that it's right. So you do need to consider how much work should go into it, and that's always a key part of the decision in terms of what to do when it comes to transfer pricing.
Mm-hmm. And
you've got to break out where's the big money, and that's where you've got to really spend your time. And that's why I do believe, and I think you talked about it in other session, Geoff, there's something to be said for some rules of thumb, on the smaller ones. Now, I know that SARS used to spend a lot of time on the smaller stuff, like the services. They've gotten better at focusing on the bigger ones, but your revenue authority's also got to be thinking straight, because you don't want to be spending a lot of effort for just small amounts, because it's just too small. Anyway, so
I mean, in my 20 years, I was running the economist practice. We had 50 staff of economists. All they were doing every day was transfer pricing. Every senior leader had 20 cases, so that's up to 150 cases, 200 cases across the practice. And everyone was laser focused on, if I'm doing the $1 million issue, then I'm not doing the $100 million issue.
Yeah.
You've got to change your thinking.
Yeah.
But, part of the problem.
Straight from a tax authority perspective, right?
Yeah.
That's exactly it. You're saying, why am I focusing on 1 million when I could be focusing on 100 million?
Yeah.
It's logic. Makes sense. Makes sense.
Yep. And we would, the kind of conversation would be, how can we not do the $1 million issues? And that's when we started to develop things like safe harbors that weren't real safe harbors, the guidance that the fiscal would put out. So if you do this, we won't review you. It might be wrong. We're not going to look at it, but in the meantime, we're not going to look at it. So took all off the table, all of those smaller issues, and got us focused on the much bigger issues. And it took us 5 years to do that, even start that process. Because you needed that lead long to convince everybody that you can't audit your way to success. That's a really big thing. But the last slide here I've got is really, just to kind of bring out some final thoughts on litigating transfer pricing. And the one issue that comes up all the time is, is TP litigation just a re-arguing of the issues in audit? And my response is that, well, maybe, but, in litigation, you might have new facts, new evidence, new witnesses, new analysis, new perspectives. It might be, a whole lot of fresh insights, one step removed from all the kind of argy-bargy that went on in the audit and trying to get that settlement. And of course, when you get to the rule of law, they usually, dictate what arguments that need to be followed, and the rules of evidence and the OECD guidelines may not even make it into the courtroom. And the TP documents might only be essentially be a stepping stone to far more meaningful issues to be discussed in the court. And we've talked about, where the onus of proof lies. Each side needs to rebut each other's arguments. And even if the fiscal has a weak argument, and we could poke holes in it, till the sun shines through it. But if the taxpayer doesn't have anything, then the court might be left with a decision. I'll take something that's not great versus nothing, and they might take something that's not that great. And I think I've seen a case in South Africa very similar to that. But the advantage of the taxpayer has in these litigation is that they can use their industry and commercial knowledge. They knew what they were doing when they set these prices. They knew why it made sense for them. And they can put people on as witnesses to talk to that. And of course, you might find new information as well. And I've been in one case where, as the tax office guiding the lawyers in how to deal with a case, and the taxpayer rang up one day and said, "Oh, I found a folder of information in a cupboard in the Swiss parent company." It's like, but we're 6 weeks away from court. Well, we're going to look at it. You should look at it because they come through discovery. And the company's managing director talked to it as a witness. The company's transfer pricing expert talked to it as a transfer pricing. It was CUPS, so went to the transfer pricing analysis. Our expert had to talk to it as a government witness. So I created a whole lot of issues around what the right answers were, and I have to say, taxpayer won that case. They found new information.
Yeah.
And the MD could talk to it.
Yeah.
It's really, really important to, make sure that you don't see litigation as just a narrow re-litigation of the audit case. And of course, the other parallel process is continue negotiating. If you think you've got a strong case in litigation, you might get a great settlement before, and settle on the courthouse steps before you get to litigation itself. And so, obviously, Kabrini's talked to, managing TP risks, the focus areas and the risk areas. Monitor those key trends. The legislative tests are changing. There's transfer pricing is being litigated by other taxpayers as well. Think about tax transparency in the country by country. If one of your related entities has got an APA for a similar issue, you might be able to use that as evidence no risk to the revenue in your jurisdiction. Think about building your own skills in-house, or getting external support. Audits cost time and money, as we've talked about, and obviously there's APAs, MAP, voluntary disclosures, and litigation, all ways to resolve disputes.
Great.
That's it, I think.
Thank you so much, Geoff. I'm going to just wrap up here, and then I'm going to hand it over to Keith for some final words. But in terms of what's next step, what we're saying really, and from what we're seeing from the tax authorities and taxpayers alike, is we need to be defense ready when it comes to transfer pricing. And not everybody needs to have a robust approach to this. It depends on the commercial rationale and the business risk and the transfer pricing model that's specific to the particular client or business. Robust documentation is considered critical as the first kind of stepping stone in terms of your defense strategy, and supporting evidence is becoming more and more important. Because you basically, as you say, whether you go to court or it's just in terms of your dealings with the tax authority, you need to provide evidence to support any assumptions that you make or various things. So there is a certain amount of documentation that groups and entities should actually be compiling. Stakeholder involvement and understanding. What we said is, this isn't just like a normal tax that we tax geeks can sit in the corner and do our documentation. It is a collaborative process, and it does require the business to partake in that, because there's so much about the commercial rationale, the economics of the situation. That's really important to the narrative, and explaining that clearly from the outset can actually save so much time later down. Once you get into an audit or an information request, it's much more complicated. So in terms of that, both Geoff and I are more than happy to do it. Any questions around controversy or transfer pricing in general. And thank you so much to Geoff and Keith for joining us. But Keith, if you could close up this session for us and give us your final thoughts, we'd really appreciate that.
Yes, I like this final slide because this is what I was thinking about, and that is, look, transfer pricing is different kind of compliance than any other kind. That's really the point. So if you're a company and you're looking for compliance and you're shipping it out to a third-party consultant, you're doing that for assurance that when you submit the return, that it's not going to be challenged, or it could survive a challenge. But this one isn't just about filling out the forms and then putting a little bit behind it. Unfortunately, just doing what's expected isn't worth anything. What you really have is that robust documentation. You need to be defense ready for litigation, so that when you're building it, it really requires a lot of effort, not the documents that necessarily you're submitting, but the ones that you keep on record. And it's a real practice management effort, which makes it very unique. And the risks here, even though it might be costly, is very high. Because even a small recurring transaction, if you blow it 1 year, you've blown it for 10 years. So unfortunately, there's no easy way out. There's got to be some time and effort put in this. And it is unique because it isn't fixed rules. There's only a good narrative is your best defense. So those are my thoughts on the matter. And I love what you've done here. And I think we've gotten into it quite well. And we look forward to the comments on this and more engagement. I'm sure the companies watching this will have something to say. Thank you so much, both of you. It's always a pleasure.
Thank you so much. Thanks,
Pleasure.
Keith. Thanks, Geoff. Thanks, everyone, for joining us. Bye-bye.